Hello, and welcome to Lesson 2, Gross Unearned Income. By the end of this lesson, students should be able to discuss community property and innocent spouse equitable relief provisions, identify and describe various types of investment income, describe the tax treatment of various investment transactions, and learn about the tax attributes of special purpose accounts such as Roth IRAs, education accounts, and annuities. We're focusing on unearned income in this lecture, but first let's take a step back and refresh our memories about when income is taxed. As we learned last week, this depends on your tax year and tax accounting method, so I wanted to talk a little bit more about fiscal year ends. As we discussed last week, 99% of individual taxpayers must use a calendar year end. So we're talking mainly about businesses and also some trusts. If they meet certain requirements, they can have a fiscal year end, which means their tax year end may be, for instance, May 31st of a given year. When that happens, it's important to know that the calendar year taxpayer, so the individual who owns that interest in the partnership or who is the beneficiary of the trust, they pay tax on the income reported on that K-1 in the calendar year in which the fiscal year ends. So for instance, if a trust or a partnership ends on the fiscal year ends on May 31st of, let's say, 2019, the individual who's receiving that K-1 will pay tax on that income on the calendar year 19 return. Now this can be a little bit confusing because when you get that K-1 for the period ending May 31st of 19, it's actually going to be on a 2018 form. And the reason is because when the preparer goes to prepare that tax return in June, July, or August of 2019, the 2019 forms are not going to be available yet. So they're going to have to use the 2018 forms. However, the rule is that the taxpayer, the calendar year taxpayer, picks that up in income in the ending year of that fiscal tax year. And the reason is because, again, if we're talking about a May 31st year end, let's say the tax return is prepared on time, that would be, say, an August or September time frame when the individual would be receiving the K-1, that individual may have already prepared and filed the tax return for 2018. So the timing doesn't really align if we use the beginning of the fiscal year end to match up, so we use the end of the year. Just an important thing to keep in mind if you have clients with investments or who are beneficiaries of trusts with a fiscal year end. Next, we'll talk about when gains are taxed. So we're all in the financial planning program here. We're familiar with investment portfolios, regardless of how they're invested, whether it's fixed income or equities. That value of the portfolio is going to change from day to day. And I think most of us are familiar with the idea that the change in the value is not reported on an income tax return every year. It's not the unrealized gain that's reported, but rather the realized gain. That's what gives us opportunities for tax planning, either harvesting gains when sometimes that makes sense, or harvesting losses to maybe kind of modify some of the gains that had occurred earlier in the year. And of course, interest and dividends are taxed when received. So just important to keep in mind that it's just the realized gains that are taxed, not the unrealized gains in a given year. And then finally, I wanted to say a few words about barter transactions. A lot of taxpayers, a lot of clients are not aware that barter transactions can generate taxable income. Now, this isn't a problem if this is personal transactions. It's not a problem necessarily if it's a business-to-business transaction. So I prepare the tax return for someone and they do printing for me. So presumably the value of the product or the service, the printing service that I receive for my business is roughly equal to the value of the service that I've provided. The problem comes in when, let's say, I prepare the tax return for the woman who cuts my hair, and then she cuts my hair in exchange for that service. Well, I'm providing a business service, and for anybody else, I would be receiving cash for that tax return preparation, but a haircut is not a business expense. We'll talk about business expenses next week, but just trust me on this one. Haircuts are never a business expense, regardless of your profession. So that's where we get into trouble, both with sometimes I don't know that there have been barter transactions unless a taxpayer tells me that, and then also the value as well. Bottom line, if you have clients who are engaging in bartering, particularly, although not only, if they're business owners, sometimes investment bartering can be an issue as well. If your clients or you are engaging in bartering transactions, just know that that can result in taxable income. Next, we're going to talk about community property. So community property is important. It's an important concept for a number of reasons. Community property, I guess first it's important to say, is a type of property law, and it is state law. And each of the community property states listed here, you can see there are 9: Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. All of these states are community property states. Each state maybe has a little bit different community property rules. There are nuances, particularly California tends to be a little bit different than everybody else. But there are some general principles about community property that we can talk about. This is property law. The rest of the country, the other states that are not listed here, those are separate property states. Community property law is important, certainly in the case of divorce planning, or if in the event of divorce and property distribution. It can be important for estate planning. So in your estate planning class, you'll talk about adjustments at date of death. It could be, we talk about step up in basis, but it could be a step down. So community property is important there, but there are a few income tax implications, and that's what we're going to talk about here. But first, let's talk about exactly what community property is. In a community property state, it is assumed that anything earned during the marriage in a community property state is property of the community. So it doesn't matter whether the husband earns the income, the wife earns the income, whether the investment portfolio, provided it's community property, earns interest and dividends or capital gains. All of this is for the benefit of the community, and each member of the community owns 50%. So that means I live in Arizona, 50% of what I earned belongs to my husband and is taxable to my husband, 50% is taxable to me, and likewise 50% of what my husband earns is taxable to him and 50% to me. Now, before we talk about the income tax implications of that, there's another important concept within community property that's important. It's called sole and separate property. So it is possible for people who have always lived in a community property state or people who are coming from a separate property state to come into a community property state and have what is called sole and separate property. Sole and separate property comes about in two different ways. If members of a couple, spouses, have assets that they bring into the marriage when they get married, those assets, 401k plans, checking accounts, real estate, investment portfolios, personal property, those assets are sole and separate property. When they get married, they can continue to be sole and separate property, or if those assets become what is called commingled, then they become community property. So it may be easy enough to keep a checking account or an investment account or even real estate separate. Just don't put any additional money, community money, into those accounts. Don't make distributions. Don't make withdrawals. That's easy enough to maintain sole and separate property status if you choose to. But assets like a 401k plan, there's a balance when you get married and you come back from your honeymoon, and your next paycheck, you're contributing into that retirement plan some more. But when you're contributing after the marriage, you are contributing community money. Now that asset becomes commingled, and effectively that asset becomes community property. Now, there's nothing necessarily wrong with making things community property. There are benefits, certainly, as we mentioned earlier. If you are married and one spouse passes away, 100% of the community property gets a step up in basis. We hope it's a step up, as opposed to half of a jointly owned asset in a separate property state. Or if I am holding sole and separate property and my husband passes away, I get no step up in that basis. So there are good things, good attributes for community property, but certainly there are issues to consider when planning for divorce, asset splitting, alimony, things like that. And then there's also the income tax implications. So sometimes clients will ask, regardless of if they're in a community property or separate property state, they will ask, should I file jointly or separately? Regardless of whether you're in community property or separate property state, 99% of the time, it's always better to file jointly. And we'll talk about that in another week. But certainly for community property, it almost never makes a difference, because if the income is all community income, if I were to file separate returns, I have to pick up half of my spouse's income on my return, and he has to pick up half of my income on his return. So there's very little opportunity to take advantage of deductions that are indexed or eliminated or have a haircut based on income when you have a community property situation. It's important, though, to be able to explain to your clients about that. And some clients will say, well, we live in a separate property state. In fact, I have a client in Colorado. He lives in a separate property state. He's working in the state of California. He's going to be considered a California resident. And so how do the community property rules play into one spouse being a community property state resident and one spouse not? It can get very complicated. You want to make sure that you're well versed in the rules, because certainly the state tax authorities want to make sure that they're getting everything that they're entitled to. And indeed, the IRS would also be looking at community property issues if the issue ever came up on audit. So before we leave the issue of community property, advice that I have for you when working with married clients who have a sole and separate property issue. So again, if you're in a separate property state, doesn't matter. However, you should make sure that if you live in a separate property state, but you're dealing with a client who's in a community property state, you want to make sure you counsel them on these issues. I always make sure that I let clients know about the sole and separate property concept, regardless of how long they've been married, how happily they appear to be married. I always want to make sure that they are aware these are the pros and these are the cons of commingling assets, because most marriages start out happy. The ones that always end unhappily. And so you want to make sure that they are making informed decisions, certainly for malpractice reasons, but also just to give them the information they need to make the choices that they need to make. So I think that's enough on community property. Talking a little bit more about marital situations and marital situations that may deteriorate, let's talk about some relief provisions. In most marriages, there's a division of labor. One spouse is responsible for certain things, another spouse is responsible for other things, and there's no need to duplicate efforts, right? That's what division of labor is about. Quite often, income taxes is delegated to one spouse. I do have a few clients where both spouses are actively involved, but by and large, I'm working primarily with one spouse, with hopefully the other spouse engaged enough to be informed about what's going on and ask questions, but unfortunately not always. So when you have that division of labor and you are trusting your spouse to report income accurately and make all tax payments, you're placing a lot of trust in that spouse. Sometimes, unfortunately, spouses can find that trust is misplaced. It's also important to remember that when you sign a tax return, and this is whether you're married, single, head of household, the owner of a business, the trustee of a trust, when you are signing a tax form, if you were signing the old-fashioned long form, filling it in and mailing it in paper, It says, I certify under penalties of perjury that this information is true, correct, and accurate to the best of my knowledge. When you sign off on that, you are responsible. So when you have a married filing joint return, you are saying, to the best of my knowledge, this is true, accurate, and correct, and I am jointly and severably responsible for this tax liability. Sometimes that trust is misplaced. Sometimes spouses are willfully ignorant, but sometimes spouses just really don't know everything that's going on in the financial life of the other spouse, and that can open that spouse up to exposure. It can certainly open a spouse up to exposure when two spouses are still married, but that exposure can continue even after divorce. So remember, there's at least a 3-year statute of limitations, and as we learned last week, if there's a significant understatement of income, that statute of limitations can expand to 6 years, and as we learned, fraud has an unlimited statute of limitations. So you may have been divorced for a year, for 3 years, for more. If you sign that tax return, which is subject to significant understatement or fraud allegations, you could still be liable for taxes eventually assessed, even though you have been divorced for any period of time. The separated spouse and innocent spouse relief provisions are designed to give spouses who weren't willfully ignorant, who genuinely did not know what was going on, a little bit of relief. Now, in the old days, innocent spouse and separated spouse relief was extremely hard to get. It was almost impossible. About 10 years ago, the IRS did make the regulations a little bit easier, but still, it's not a cakewalk. It's not easy to get. This is not for people who say, gee, I didn't know. I drive a luxury car. We have a multi-million-dollar house. We consume luxury brands. We take great vacations. We fly private jets. And our income was only $100,000. I didn't realize that all didn't compute. That's not what this is about. This is about spouses who participated in a normal and logical way without being suspicious and paranoid. There was no reason to suspect that anything else was going on that you weren't aware of, that wasn't reported on the return, whether that's illegal activity that needs to be reported, because remember last week we talked about illegally derived income still needs to be reported, whether that's secret accounts that a spouse didn't know about. If documents aren't coming to the house, and if a spouse really wants to hide something, is determined to hide something, that's what this innocent spouse or separated spouse relief is all about. Similarly, equitable relief. So again, you're divorced. This tax burden is following both of you now around. One ex-spouse is a hedge fund executive, the other is a teacher. The IRS can use equitable relief to say, okay, maybe more of this tax liability, or possibly all of this tax liability, needs to be paid by the spouse who really earned all of this money way back when. And hand in hand with that, the disallowance of the community property treatment, because if we're talking about Arizona or California or any of those other community property states, doesn't really matter that the hedge fund manager was making all the money. In theory, half was going to the school teacher's spouse, now ex-spouse, but in certain circumstances, the IRS can disallow community property treatment if that's what makes the most sense. They can also disallow community property treatment if it still isn't a logical way to tax taxpayers, and it is punitive to the taxpayer. So the IRS does have some discretion there. The last thing I'll say about these relief provisions, even though they are easier to get than they used to be, I've never even applied for one. They are not cheap. You need to be able, there's paperwork, of course, that you need to file. You need to be able to prove that you didn't know and had no reasonable basis to know about whatever was happening or wasn't happening on the tax return, wasn't reported. And it can be expensive, and so certainly we're not we're not even talking about $5,000-$10,000 worth of taxes. We're talking about a significant amount of tax that is following this ex-spouse around, where it actually makes sense to invest the cash in legal fees to make sure that that relief provision is applied. But certainly there are professionals, mostly attorneys, but some CPAs who specialize in these provisions. And if you ever are doing pro bono work or even end up having a client who has these issues, know that these are tools possibly that you can use in your toolkit.